Welcome to Colliers Talks, a podcast series featuring the latest trends, insights, research, and developments in commercial real estate in Canada and beyond.
Welcome to Colliers Talks Economics. This is our regular podcast where we discuss the big picture economic topics and, of course, how they relate to the real estate world that we're all so interested in. So I'm pleased to be joined by a new guest, hopefully a multiple-time guest in the future, Marianne Skorupski. She's the Director of Office Research for Colliers in the U.S. So we're doing something a little bit different today, where there's a bit of compare and contrast that we're going to do. Marianne, thank you for being on our show. I'm looking forward to chatting with you.
Thanks for having me.
Okay. So as I said, the theme of this episode is not so much what's happening with inflation data or where are interest rates going. We've talked plenty about that, but it's a little bit about looking at the U.S. market and maybe helping us in Canada look into the future a bit, or how comparable is what's happened in major markets in the U.S. to what we're seeing in Canada in terms of development, return to office, leasing, all of those office topics. So I know that we've had an office-specific podcast for a while. So Marianne, welcome. Are you ready for me to get into this?
I think so. I think we're good.
Okay, so let me set the stage for you. We just had our big recovery quarter. We had the best leasing quarter in Toronto in 8.5 years. We had the return to office announcements in the sort of back half of 2025. And now we're seeing it in the absorption, in the leasing, in the demand for space, in vacancy finally coming down after 5 or 6 years of rising. But I can't help but thinking that's what you went through a year ago, maybe even a year and a half ago. So we're lagging a little bit. I think everyone's aware in Canada we're maybe a little bit behind on the sort of return to office curve that some other markets have. So give it to me from your side. What's happening in the U.S.? What happened over 2025? What did you see, and where can we forecast that forward for Canada?
Sure. I think we could actually start the conversation with 2024. So the post-pandemic period really started to see signs of recovery and, dare I even say, little green shoots of expansion in a couple of select markets with leasing activity. We started to see volume, especially in our bellwether cities and markets of San Francisco and Manhattan, really taking shape and volume starting to rise significantly. And then in 2025, we started to see the results of that leasing activity. And so Manhattan had a record year in 2025, which is kind of amazing to think about in just their history. But they absorbed the most amount of square footage in a single year, which really drove the momentum for the U.S. market as a whole. However, we have seen signs of recovery and stabilization in significantly more markets around the country. We've seen Miami, which was a benefactor of the post-pandemic immediate leave the big cities, migrate to Florida. They really saw a big boom in that 21-22 period. And now we're starting to see some growth in other markets where there's stabilization. Boston and Detroit specifically had a great fourth quarter to help balance out their activity. So we've started to see that stabilization kind of stop the bleeding in many ways, if you look at it, for the office market to head into 2026 on a much more positive footing, to be able to move forward and really start to see what the new normal looks like.
Okay, but it wasn't a one-time, one-quarter thing. You saw a sustained year and a half of, okay, leasing is back, demand is back. And can I ask, like, where it's across the board? Is it, you hear the big high-level announcements, maybe banks or governments, but tech, banking, insurance, government, media, like, is it just kind of wholesale everyone, or would you say there's one sector where there's just like bigger momentum?
I think it depends on which market you're in. I think everyone's probably very familiar with the headlines of AI and the leasing in the San Francisco market. So San Francisco is really starting to see the fundamentals reflect the significant leasing from AI companies over the past 18 months and continuing, right? There's still a significant demand for space that has not been signed yet. So we expect that momentum to continue. We're starting to see it in the absorption and vacancy rates flattening, which is positive for the market, which has only seen explosive rise post-pandemic. So, that's one market that's probably been driven more by one industry than others. But Manhattan has seen that growth from multiple industries, driven by the financial sector, but that's also because it is more heavily weighted with the financial sector and banking firms. Um, Overall, in the U.S., a lot of the leasing momentum is driven by the banking, financial services companies. They just tend to be the bigger users or more of the needle movers for large leases, if you will. But we're seeing activity spread across multiple industries with multiple markets. So it's a good sign.
Okay. Let's get into the details of this a little bit more. One dynamic we're dealing with here is that traditionally downtown is more desirable. Downtown has higher rents and lower vacancy and more development. Uh, that just in the last couple of years has flipped though. Downtown has some challenges. Downtown has higher vacancies. It might still have higher rents, but for a number of reasons, the ownership profile here, the tenant profile here, we're actually finding a situation where downtown vacancy is now at a higher level than the suburbs, which is surprising. And there's a part of me that says that's just temporary. That's not the way it works long term. But in this new post-pandemic reality, day is night, up is down. Maybe that is the way it works now. What have you seen in the suburbs versus downtown? Because the suburbs are offering a lower cost, a shorter commute, free parking, some basic things that maybe have a little more value than they used to 5 or 10 years ago.
Right. So we experienced the same with the flip of the downtown versus suburban vacancy, where suburban became the lower vacancy in 2022, I believe it was. But that's on an overall level. I have noticed when you dig into the Class A, right? Because that's probably one of the other components is that big bifurcation of the market. That Class A top tier is driving all of the activity right now. And when you look at Class A in the CBD has a lower vacancy than Class A in the suburbs for the U.S. So we're still seeing that trend. I think what is happening again is, as we talked to, or as I mentioned, the bifurcation of the market, the B and C buildings in the downtown cores are seeing less activity because they typically aren't in the better locations, maybe don't have as many amenities. And so they just don't have that same draw as a lot of the new construction that we saw in several of our downtown markets over the past 8 to 10 years, really. So, um, I think that has helped with driving the Class A vacancy down in the core, right? You have that upgrade of space if it's available. Maybe you pay a little bit more, but in reality, a lot of our tenants are downsizing as they upgrade. So, there is that factor that's playing into that core versus the suburbs. And we also haven't had quite as much construction in our suburban markets, which is partially why the overall vacancy is a little bit lower because it's been able to just have the natural activity in the suburban markets, but didn't have the new construction to drive it up initially and then to see that decline. So a couple of other metrics that are kind of driving that suburban feel.
Yeah, certainly the development side here was beyond skewed to downtown. I mean, downtown was where everything was getting built. We were adding what would have been a lot of space even before the pandemic. And then with remote work, it was just, there was no way it could possibly be filled during that time. But again, tell us what you experienced in the last year, because now we've suddenly, in just a period of a quarter or two, find ourselves in the complete reverse situation. Before it was too much supply, not enough demand. suddenly supply is basically going to zero. I mean, I'm not sure I don't think we're building any more towers in downtown Toronto or Vancouver for the rest of the decade. And suddenly demand is, I don't want to say higher than ever, but certainly way back up from where it was, I don't know, 3 or 4 years ago. So um, that's good in terms of rebalancing the market. But like, how much, I don't want to put you on the spot for numbers. I hate when people do that to me, but we had a great leasing quarter, but I've had some people say to me, okay, so what? Vacancy went from 14% to 13% with a great quarter. Like, that's still really high. That's still not an environment that anybody wants to
Right.
develop in, or maybe, it's still a problem. Like, how much have you seen things come down? Does vacancy come down 5 points, like more? How much of the pull down from the peak vacancy have you seen, and how much more is there to go, do you think?
So we're only down about 20 basis points from our peak, which, that's over a 6-month period to be put in context. So that's still pretty significant when you're talking about, a 6 billion square foot market. So what is also helping as part of this is the removal of obsolete buildings that are going for conversion. So, we have, as you talk about, a significantly diminished construction pipeline. I mean, we were at over 150 million under construction prior to the pandemic, and now we're at 31. I mean, we're very little space, which, considering we were climbing in a development cycle prior to 2020, we still had a lot of overhang that had to complete, but now we're in an environment where it's really hard to get the pre-leasing commitments to go ahead and build a new building for multiple different factors in many markets. I think we've only seen a handful of new buildings that have kicked off in 2025, banking that by 27 or 2028 will be in a better position with activity. But again, we still had a lot of buildings that were developed in 21, 22, even a few in 23 that are now benefiting from being newer, having more amenities, more efficient floor plates. And so there is that activity that's heading into those buildings that were built in that 2015 to 2022 timeframe, if you will. But again, helping offset the rising vacancy that we had seen is the fact that there are a lot of obsolete buildings that maybe their future is not as an office building. Now, it's not every market, it's not every office building, but there are select markets that are starting to see a significant impact from conversion to another use because they just aren't the desirable office space anymore. And so tenants aren't either looking at them the same way or they just aren't driving that demand. But there's a reality that might be different depending on which market they sit in.
Yeah, and conversions, burning hot topic, one I have expressed some skepticism on. We have a big success story here with conversions with a very big caveat, which is that Calgary, which was our highest vacancy market, has seen a bunch of conversions. It's had a very significant impact on downtown. I think everyone would agree. Some creative ones, affordable housing, hotels, whatever. Read the fine print, and Calgary pays $75 a square foot to landlords to convert obsolete buildings. Suddenly there's a lot of wiggle room and it's very attractive. Other markets don't have that, and we just haven't seen conversions happen. However, I read the news from the U.S. and it's different. We bought this building for $2 a square foot, or something, maybe not quite that, but really
Right.
kind of amazingly like pennies on the dollar type things where it's just about the land value, that you're not buying it for lease up or anything like that, or filling the space. So is it just happening in the weaker markets where you're buying at such a discount that there's almost, it's worth putting in the capital? Is it incentive programs, city government, local economic development pushing this? Like, give us the contours, because here Calgary is a huge success story, but people ask me about, what about downtown Toronto? Like, the price per square foot for office, it doesn't make any sense to buy these even in a weak leasing market and be converting them. It would have to be,
Right.
90% lower than it is now. But how is that happening in the U.S.? Give us some color.
So I think it's fairly no, maybe not quite so rare, but it is less common in your traditional downtown core of your office markets where you're going to see this. It's starting to really take shape as you start to get away from that immediate um, office, centric environment to start to get into your mixed use environment. So we're seeing a lot of that residential conversion in Manhattan. So, there are some of the submarkets that have properties that they've identified that really have a better use as residential. And again, I think one of the pieces that's feeding into this conversation is just a lack of housing. Most of our markets are still significantly low in the housing stock. And so, local municipalities are struggling to figure out what does that look like? Where can we find new stock? And so Manhattan, as an example, has identified a significant number of buildings that work to become a residential 2.0 life. We're also seeing significant number of buildings in the DC market that are slated for conversion to residential. One of the interesting notes that we see in the Boston market is several office buildings slated to convert to life sciences. However, with some of the ups and downs that have been happening in the life sciences market in Boston, there's actually been some buildings converting back to office, to
Never
traditional
thought I would
office,
hear that.
right?
Converted
Because
to
there was just,
office, not from. Yeah.
yeah,
Okay.
just better momentum for that market in that moment. We actually have several buildings in the Midwestern markets that are looking to convert to industrial use because that's more of the need in the moment. I do think for all of these different markets that are experiencing the ability or the interest in converting, it's important to have the buy-in and partnership with the local municipality because that's who's going to help with ensuring a seamless process, right? So it's making sure that you can't just buy a building and hope that it can convert because it doesn't work like that for every building. And so it's doing the due diligence, it's recognizing what makes sense. We've got a couple buildings here in downtown Atlanta, one of which converting to housing that the city is putting its efforts behind because it's in a part of town near a university that really could utilize some more housing and help with just revitalizing the traditional downtown area. So, but the city is significantly behind it and helping to drive that momentum. And so I think that's a key piece in any of these conversations is the partnership between owner, developer, municipality to get that process over the finish line.
Agreed. And the conversion thing it's strange. It ebbs and flows. I think we forget that there was a time when it all went the other way. If you've ever been in a brick and beam office,
Yeah.
that was a conversion the other way. It used to be a light industrial something or a loft or something like that that became office, and now we're on the other side of the cycle. I guess heartening to hear conversion to office is being considered. I hadn't heard that. Okay, but we're sort of drifting into the investment side of this. We've talked about leasing a bit. I might still have one or two more return to office questions, but um, office investment has been a little dormant for a while.
Yeah.
And it's just kind of death by a thousand cuts. I mean, we hear different things. We hear that it's about leasing. We hear it's about flight to quality, and there isn't the appetite for the older buildings. We hear it's about pricing. We hear it's about lending a lot. Like lenders have to be able to open their mind to office. And for a long time, that was just, all the apocalyptic stories. It was just kind of a no-go. We don't like office anymore. Do you see that? Like, given that you're a little further along in this recovery cycle, do you see the investment side following along? I mean, my view is usually like the leasing happens first and then the investment kind of follows on. You see vacancy dropping, you see strong demand, and then suddenly the investors pile on. But how much have you seen the office investment market come back, and how much are lenders kind of willing to consider this asset again?
Uh, I think there's a big appetite for office now. I think it's just a matter of for investors who is going to be investing and how much and where. I think that's the piece that those are the pieces that are really coming into play right now. The past 3 years, I guess, what I'd probably say have helped to give visibility into what the office is going to look like moving forward. How is it going to be used, right? We've talked about the return to office mandates that have been in the headlines with, major Fortune 500 companies, and then even in some of the local markets where major employers are either going on record for 5 days in the office or a more hybrid focus, but it's a majority in the office. And so there's a bit more comfort to what the office is going to look like moving forward. And now that stability that we talked to earlier with the metrics and fundamentals improving, a lot of investors are looking at office as an opportunity. So they've sat on the sidelines waiting to see what's happening. And now this is the time to take advantage of those opportunities, whether it's through loans that are maturing with an owner who is either trying to get out of the market or get out of the property for one reason or another, or there's just somebody who's changing their investment mix. And we've seen some office ownership groups decide to leave one market completely. And so it opens up opportunities for investors to come in and see if there's a deal that they can achieve. But, so there's a lot of capital sitting on the sideline that's just been waiting for that stability to, get in at the bottom. And so we've seen a big diversification actually compared to um, maybe our traditional investment mix of buyers coming from more areas, whether it's a brokerage or a private investor or an institutional or a REIT or foreign money coming into the U.S. It's a bigger mix of buyers, which is an interesting phenomenon to see happening, especially for some of our gateway markets where folks are looking at opportunities to get in, where they might think the market has bottomed and it's only going to go up, and so they want to be able to ride the wave.
And the relative appeal of office, I think, has improved for, if you've
Mhm.
talked about 4 years ago here, and I think in the US too, a lot of that's flattened out. You don't get 30% rent growth forever. It levels off, the development cycle balances out. Housing seems to have come back to earth in a big way between interest rates. I read an amazing thing the other day. It said, it was looking at Texas versus California and said both of the rents are basically back to where they were 5 or 10 years ago. They went through California completely collapsed, Texas went crazy, and now the cycle plays out and they're both about back where they started. So all of that, you're missing FOMO type stuff for the other asset classes, I think has really died down. And now you're looking at office in terms of like, okay, vacancies are dropping, rent growth might be returning, development's basically zero. I might have a setup for a pretty favorable situation here. Now, you put out a lot of good content. One thing we saw from you recently was that like distress office investment is quite high, a 10-year high.
Mhm.
We could say that it's a bad thing. Obviously, distress means the market is weak and people are under pressure, but it also means people are willing to buy, like that there's a demand for those. So you mentioned like the private investor especially is willing to make a bet on office. And we have a very heavily institutional market, I think more than the US, huge like pension plan type ownership. You don't see them buying office, at least not yet.
Mm.
They'll sure buy new office. I think they're a little careful. They want to stay diversified, and buying more office isn't where they're looking. But the
Right.
private investor has a different outlook on this. So, like, can you elaborate? Like, why is that? They underwrite things differently. They see it. They're looking longer term. They're looking more about like the price per square foot versus like the relative value. Like, why is the private investor kind of driving that side of the market?
I think there's opportunities. As I mentioned, we do have some institutional investors who are making decisions about leaving markets or really significantly changing their holdings in a specific market. And so that has allowed opportunities for private investors to come in and pick up assets that maybe would not have been quite as available previously because of the investor mix, bringing that capital into the market. I think with some of the um, properties that have been in distress, the individual private investor is able to make it make sense a little bit more easily than some of the other investor types where they might have a more rigorous process, or they might have a checklist that has to have a few boxes checked that maybe a private investor has a little more flexibility. Right. And so there's opportunities, whether they're coming in with more cash, um, or their loans. It really just depends, again, on the individual market and the individual asset, where you're starting to see just that different dynamic.
And what one thing we hear is, interestingly, sometimes maybe even the private investor has a longer time horizon, which is
Hmm.
funny to think compared to an institution or a pension plan that's there forever. But
Right.
they're saying, okay, maybe this doesn't make sense, quote unquote, financially in the next 5 years. But if I look at the next 20, this is a great asset. They're going to expand transit. It has redevelopment possibility, whatever, so kind of a different set of considerations than just let's look at the cash flow in the next 10 years. The deal works or it doesn't. I think certainly, and I should correct myself, like institutions do buy, but they buy at the top of the market. They don't buy distressed assets or things like on the C-class office. It's
Not
a
as a
different
general
market.
rule. Yeah.
Always. Yeah. Yeah. I mean, the investment side is highly, highly, highly sensitive to rates and inflation. And I think um, the last year didn't quite go as planned, right? Like, I think we were certainly expecting, okay, like the trajectory for rates is just straight down. The only question is, do they end at, 1% or 0.5%? And then we really got the brakes slammed on that because of geopolitics and the trade war and everything. So I think rates, fair to say, like rates are still higher than expected. So like, how is that impacting investment? Or people are going to wait until there's more rate cuts, or it's affecting pricing so that the market can still happen? Like, wait, where is the like kind of macro interest rate impact here on the office market?
I think there's a better understanding of the market. So most investors are not sitting waiting for rates to go down, saying, well, I'm just going to wait because in X number of months we'll see it go down and then I'll buy. I think that there's a general consensus that the rates are where they are, and we have this capital that's been sitting on the sideline. Now we have to deploy it. We have to put it somewhere. We can't just keep sitting on it. There's, for better or for worse, there's been stability because rates really have not changed too much, especially on the treasury rate side for us. So it's okay, we have a little bit more comfort of what we're looking at, what the environment looks like, what are the different impacts, and now we can go out and spend. We're going to still be, maybe not picky, but we're going to be strategic with which assets we want to purchase, or if it's a buy and sell opportunity. There is that piece of it, but there's definitely a better comfort with where we are in this environment, and that we've been waiting long enough. Now we need to put our money somewhere, and figuring out what that um, property mix looks like. Office, as we've talked about, has definitely come down in that percentage of the overall mix for a lot of investors who invest in multiple property types. But we've definitely started to see that change as folks find opportunities, or properties that they want to potentially purchase. We also, on the flip side, have not seen too much for sale. So it's been an interesting marketplace right now, with trying to understand those dynamics, and it really becomes very localized, very in depth, to understanding the activity and the drivers in a specific market.
I agree, and I think just we have this same observation that look, the bond rates really haven't changed that much for like
Yeah.
quite a while. Like if you looked at how much fluctuation there's been in the world, you would think there would be a lot more change, and there just hasn't. However, that doesn't still mean that the environment can't improve. I mean, something we certainly hear is that like the lending side has improved. Like just there's the spreads are smaller, there's more willingness to lend. Like it's not we fixate so much on the Bank of Canada, the Fed, the bond yield, but there is the whole like lenders have a role to play there too of, what's their appetite and what's their spread and how much risk are they taking on. I I think here the view is that like lending is improving. It was very tough maybe like 2 years ago, but it's certainly gotten better on that side. Office is very tied to the labor market, obviously, what's
Mhm.
happening in the job market. So, there's kind of two sides to this coin. Like the economy is pretty good in the U.S. Like at the same time, you do hear these layoff announcements from this Fortune 500 company and that Fortune 500 company. So I have been doing some work on this, and it's very confusing because I think in the past you would just say a strong job market is good for the office market. They're obviously connected, more jobs, more people, more lease space. But I'm not so sure that's the case anymore. Like the
Mm.
connection between those two is weak to maybe even negative. Like maybe when the job market is really good, people don't want to do RTO and it ends up hurting the market. So what is your view? I don't want to put my thumb on the scale too much here, but like the labor market, where is it in the US, and is it a tailwind for office, or is it a headwind for office?
I think it's still a little early to tell completely whether it's a head or a tailwind. What we're seeing right now is a flip of what we saw immediately post-pandemic. So in the 21, 23 to 2023 period, really employees driving the labor market, right? There were opportunities they could, if they didn't, if they wanted to take an opportunity, they could move firms, and there was maybe not an onslaught of changes, but there was a higher level of movement with employees who were doing, for various reasons at the time. Now, over the past couple of years, we've seen that flip to where employers have held a little bit more, we'll say, quote unquote, power in the job market because over the past couple of years, there's been a quiet sentiment of, oh, there might be a downturn coming in the economy. We need to kind of hold off. And so there's just been we're going to status quo where we might not backfill every open position, or as someone leaves, we might not backfill two, we'll only backfill one, or, some other mix. And so there's been a little bit of uncertainty. And then when we had the presidential administration change, it was more of just trying to understand what's the new macro environment, what does that look like, what may or may not be an impact on the economy and you know, um, bottom lines, basically for corporations, understanding what the impact is going to be on their revenue. And so I think that has just held steady, which has meant employees have not had quite the amount of leverage that they may have had 4 years ago. So it's uncertainty. So you're not seeing the um, musical chairs, shall we say, from employees to the same level that we saw before. And in this environment of corporations holding off on hiring, uh, there's a real understanding that it's going to take a while. If you leave a job or you get laid off, it's going to take you longer in general to find a new job. And so that has been another factor influencing the labor market and choices that we may or may not have as we have an aging workforce that to some extent has stayed around longer in the workplace just than their predecessors. But as they retire and leave the workforce, there are not enough workers to replace them, even if it's a combination of productivity increasing just on a per worker basis, or there's technological innovations that can help assist with a person and the technology that it's just a very different conundrum for the workplace right now with labor. And I do think that the logic pre-pandemic of job growth translating directly into absorption is no more. I do
Yeah, I
think
mean,
that you
I don't think
cannot,
we've seen job
can't do
growth
that.
translate to absorption for years here. Now
Yeah.
the next year will be very interesting, but it's clear that RTO and the job market, there is some connection there, and a weaker job market is weirdly driving leasing, which I don't think I ever would have said beforehand, that like a soft job market is good for office. I think historically, if you looked at it, like a recession or a weak job market is never good for office, but it's like I said, it's a new world, and up is down and day is night, and all the usual rules seem to be, they either don't apply or they've completely gone backwards.
Well, I think
Marianne,
the
this
other
is
piece that you have is the firms that had their leases, their office leases expiring immediately post pandemic, right? So 21, 22, where they weren't sure what was happening, but let's say most of their workforce was either remote or significantly hybrid. So they were looking for cost containment. And so in many cases, where there was an opportunity, they would downsize their office. Well, now we're starting to see some of those firms expand because they downsized too much. So we're starting to see some growth from companies that did an immediate cut because they had to, right? There was a expiration driven, but now there's growth because either they're pulling everybody back in, or the way they're operating the workplace is different. So there's that component that's a fun mix because it's some growth, but it's not, to your point, tied to labor or employee headcount change. It's more of a reaction to an immediate behavior post-COVID.
Yeah, I guess that's some optimism for the next hire. Yeah, the sort of overcorrection one side
Yeah.
and then correction back the other way. We seem to be seeing a lot of that. It fully remote, fully return to office. There's been quite the yo-yo, I think, that we haven't experienced. Anyway, this has been a great discussion. We really appreciate it. But Marianne, I have to tee you up finally on your favorite topic, the impending World Cup, which will be coming to a city near almost anyone. I don't remember how many cities it is, but it's quite a lot, including, of course, Toronto and Vancouver and Atlanta and many
Yep.
other markets. So let just, speak freely. Like what is the impact, maybe not on the office market, but just on real estate generally, hospitality, retail, development, logistics? Like what is the impact of the World Cup going to be?
Well, I think we're going to see, similar to, I guess, for the U.S. markets, probably the most equivalent could be looking at a Super Bowl, right? So each individual match for the World Cup almost has the same impact as a Super Bowl to that market, just by virtue of the fans coming in, the media, and all of the ancillary support needed to put on such a game and an event of that magnitude. So you're going to see an immediate growth in the hospitality sector, right? Hotel rooms that are being booked up by media or the teams themselves and visitors. So there's a big growth for those markets, which we've seen the hospitality sector kind of take it on the chin over the past 5-6 years with the decline in business travel. And then the other component is with the recreational travel decline in some markets, specifically over the past couple of years. The opportunity to host World Cup matches will really benefit and fill the void for those cities and those hotels that have not had quite the occupancy rates that they have hoped for. And we're also going to see that in markets that are not hosting matches, but maybe hosting teams for their home bases during the tournament. And so we're going to see opportunities for benefits and economic impact in markets beyond just the 16 host cities throughout the region, to see some really good growth.
Marianne, thank you for joining us. I think we're going to wrap the show. We appreciate you helping us dig into the office market, look into the future a little bit, give us the insights from what's happening on the other side of the border. And thank you to our audience for watching and listening. This is Colliers Talks Economics, where we're with you every couple weeks with a new guest, and we appreciate your time. Thanks very much.
Thank you.
Thanks for listening to Colliers Talks podcast. To learn more about Colliers Canada, our experts, and our solutions, visit collierscanada.com or find us on LinkedIn, Twitter, and Facebook.